What if you received a big bonus from, say, your dream job? Maybe you got a scholarship from a school that you've been trying to get into, and you got paid in advance for that. But it was contingent on you doing something in the future, maybe staying with that job, going to the school, and you ended up not fulfilling that, and you had to pay it back in another year. Well, now you have income that was taxed in one year that you ended up paying back the cash for, which doesn't sound very fair. So in this video, we're going to talk through how to make sure we make that fair from a tax perspective, the best way to go through that, the options the IRS allows, and how to practically put that on your tax return. So I specifically just worked through this with a client who had signed up with, I think he was working for a university, and he got a signing bonus to start with them, but it was contingent on him keeping that job for a certain number of years. Well, it turns out in 2025, he got the dream job he was looking for somewhere else. So he already had received the bonus and went to another job and had to pay back a portion of that bonus because he didn't meet the vesting period. So for US tax purposes, the first thing we have to figure out was that income taxable in the first place, because it did have a contingency on it. And as a individual taxpayer, the IRS puts you on a cash basis, meaning that once you have that money and you have an unrestricted right to use it, that's taxable income to you, even if you had to pay it back later under some circumstances like a vesting period. But in this scenario, this person had the cash, they were able to spend it on whatever they wanted. It's just that they had to pay it back if they didn't fulfill the requirements of that job offer. So in this case, let's just use simple numbers to work through the math on this. This person, let's say, received $30,000 as a sign-up bonus just to start working with the company. And they had to keep that job, and it vested over a 3-year period. So each year, $10,000 vests. So he left in 2025 and received the $30,000 in 2024. So they only got to keep $10,000 of that bonus because only 1/3 of it vested. So they had to pay back $20,000. So they paid tax on $20,000 in year one and had to pay it back to the company in year two. So that's unfair, right? So we want to make sure that we get that money back somehow. The knee-jerk reaction to that scenario is that, of course, you just go back and amend your 2024 return and adjust the payment down from the $30,000 bonus to a $10,000 bonus. It doesn't work that way from an IRS perspective because you received a W-2 most likely, or you would have from that employer. So you can't just change the number. What we have to do is make it fair in 2025. So the IRS gives you two options to work through, and you take the better of the two results, basically. So in 2025, on your tax return, you're going to take an above the line deduction. So we'll take the $20,000 and take a deduction against your 2025 income for that. And that's going to hopefully equalize the two. But the problem is, what if your tax rate was different in 24 than 25? So let's say you had a 25% tax rate in 24 and a 20% tax rate in 25. In that scenario, you paid 25% tax on that $30,000 bonus, whereas you're getting a deduction at 20% in 25. Again, that's not fair. You've gotten less benefit from the deduction than you got when you had to pick up as income tax. So the IRS gives you another option that says you can get a credit, so a dollar for dollar tax credit for the amount equal to the taxes you paid in 24. So to put that into simple terms, we just go back and look at your 24 return, kind of like we had amended it, but we calculate your 24 tax as if you didn't receive that $20,000. So we're going to use your marginal tax rate at the end of the day. So if whatever tax bracket you're in, we're going to reduce that number, your income, by that $20,000. And the difference in your tax in 24, removing that income, is what you get as a credit in 25. So it really comes down to, you can apply either of those options. Whichever year you had a higher tax rate in, that option is going to be better. So option one, taking the deduction, is going to give you a better answer if your tax rate's higher in 25 than 24. If your tax rate's lower in 25 than 24, we're going to get a credit based on the taxes you paid in 24. At the end of the day, the objective is to remove that injustice, if you want to call it that, based on paying additional taxes. And you do it in one of those two ways, and your accountant will work through that with you to make sure it's put on the form correctly. Of course, if you need help with that, you can reach out to us and we can do those calculations for you. But at the end of the day, The point is that it's not the knee-jerk reaction of amending your 2024 return. That's the wrong way to do it under this. And they call this the claim of right doctrine, basically saying that you are allowed a deduction or a credit based on the income you picked up that you never actually received. And you can see this going the other way too. The claim of right doctrine can apply for deductions you received that you don't actually end up paying. A common example for that is like state tax deductions. So let's say you take a state tax deduction on your 2024 return based on taxes that you paid, and then you get a refund for those taxes in 25. Now you've gotten a deduction. That's unfair on the IRS side. So you've got a deduction on taxes you didn't actually pay out. So the IRS makes you do a similar calculation on the deduction side. But here we're talking more on the income side and how to make it fair on your end that you're not paying taxes on income that you don't actually receive. So if you have questions on this, if it's something we can help you with, obviously, reach out to us at McGowanTax.com and happy to talk through it with you.